As at the end of 2017, Canadians still had 88.8% of their mutual fund and ETF assets invested in actively managed products. In the US, 65% of mutual fund and ETF assets are invested in actively managed products. This would all be fine if actively managed funds were delivering any semblance of decent performance. Unfortunately, the performance of actively managed funds continues to be dismal. I'm Ben Felix, Associate Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you just how poorly actively managed mutual funds in Canada have performed. The SPIVA Canada report is a fascinating analysis prepared by Standard & Poor's semi-annually. Recently, they published their year-end report for 2017. For the first time, this report contains data going back 10 years for all sections of the report. The report compares the performance of actively managed mutual funds in Canada to their relevant benchmarks. It addresses the issues of survivorship, and it details the average performance of Canadian actively managed mutual funds. For the 10-year period ending December 2017, only 8.14% of Canadian equity mutual funds in Canada outperformed the S&P/TSX Composite Index. 22.41% of Canadian small-cap mutual funds outperformed the S&P/TSX Completion Index. 0.00% of Canadian dividend and income equity mutual funds outperformed the S&P/TSX Dividend Aristocrats Index. 1.67% of U.S. equity funds outperformed the S&P 500 Index in Canadian dollars. 6.05% of international equity mutual funds outperformed the S&P EPAC Large Midcap Index in Canadian dollars. And 2.45% of global equity funds outperformed the S&P Developed Large Midcap Index in Canadian dollars. Ouch. Those numbers are pretty bad. Of course, saying active funds don't usually beat the index is only half of the story. An index fund investor doesn't get to invest in the index without fees. After fees, 100% of index fund investors underperform the index. The important nuance is that index investors should only underperform by the cost of owning their index fund, which should be very small. We would expect actively managed mutual funds, on average, to underperform approximately by the amount of their fees. The average equity mutual fund in Canada has a fee of around 2.2%. Over the same 10-year period, Canadian equity funds underperformed the index, on average, by 0.79%. Canadian small-cap funds underperformed by 0.21%. Canadian dividend and income funds underperformed by 2.65%. U.S. equity funds underperformed by 3.62%. International equity funds underperformed by 2.85%, and global equity funds underperformed by 3.09%. In most cases, the underperformance across the board is substantially higher than the cost of owning index funds. Even if an index investor is paying 1% on top of the cost of index funds for advice to a fee-based firm like PWL Capital, they are still better off than the average active fund investor by a large margin. The question that follows these ugly performance numbers is, why doesn't it seem this bad on the ground? Mutual fund companies and banks do not have rosters of funds that have consistently trailed the index. They always have some funds with good past performance to show off. The reason is survivorship bias. The consumer only gets to see the funds that have survived. The funds that do poorly simply close and disappear. Of the funds that existed on January 1st, 2008, only 37.21% of Canadian equity funds still existed on December 31st, 2017. 46.5% of Canadian small-cap funds still existed. 62.5% of Canadian dividend funds. 50% of U.S. equity funds. 46.97% of international equity funds. And 50.31% of global equity funds. It's probably safe to say that about 50% of the funds at the start of the 10-year period continued to exist at the end of the period. This is why it is so hard for a consumer to believe that actively managed funds underperform as consistently as they do. What about the funds that still exist and beat their benchmark index? We don't have great data available for Canadian funds on that, but we can look to the US. S&P also publishes a persistence scorecard for US actively managed mutual funds. Of the 585 top quartile performer domestic equity funds in the US that existed in March 2013, only 2 funds, or 0.34% of the top quartile funds, were able to stay in the top quartile through December 2017. Interestingly, the data show that it is more likely for the best performing funds to become the worst performing funds than vice versa. All of this corroborates Mark Carhart's 1997 paper on persistence in mutual fund performance, where he concluded, the results do not support the existence of skilled or informed mutual fund portfolio managers. If managers that do well are lucky rather than skilled, we would not expect strong persistence in performance. If people who are financially independent and have more capital than they need to fund their expenses want to take on the risk of owning actively managed funds for a small chance at market-beating returns, I see no problem with that. For the average family saving up for retirement and other financial goals, I see little reason to take on active risk when the probability of a positive outcome is so remote. Do you still invest in actively managed mutual funds? Please tell me what I'm missing in the comments. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. I'll be talking about a lot more common sense investing topics in this series, so subscribe, click the bell for updates.